Welcome to Module 9 of Financial Management, and we'll be discussing working capital management. Also, this is very important in financial management. Working capital management is a vital part of financial management, and it's focused on maintaining a company's short-term assets and liabilities. It ensures operational efficiency and financial stability by managing the cash, the inventory, the receivable, the payable, and the short-term debt. Effective management of the working capital balances the liquidity and profitability, which prevents interruption in daily operations while avoiding excess capital tied up in unproductive assets. So this aspect of the study, the module, looks into the concepts, the components, the operating cycle, and financial strategies of working capital management. And they are essential for optimizing profitability and enhancing financial firms value rather. What do we mean by working capital management? Working capital management is the administration of current assets and liability to ensure liquidity and profitability. It is the management, the administration of current capital and liability to ensure liquidity and profitability. When we talk about the current capital, we talk about the short-term assets, current assets rather. We talk about the short-term assets, the inventory, the cash. Those are the current assets, and it is a way of administering every of these in order to ensure that the liquidity and profitability of the organization. So it prevents insolvency and maximizes shareholder value. What are the key objectives of working capital management? It maintains liquidity for daily operation, to enhance profitability by minimizing idle funds, also to reduce risk of operational disruption, and lastly, to optimize cash flow through receivables, payables, and inventory control. What are the two key concepts of working capital? The two key concepts of working capital are the gross working capital and the net working capital. The gross working capital talks about the total investment in current assets like cash, inventories, and receivables, as I said the other time. So it reflects the fund available for daily operation. These are daily operations, the fund available for daily operations. While the net working capital is the difference between the current assets and the current liability. The net working capital is the difference between the current assets and the current liability. So positive net working capital indicates financial stability and ability to meet short-term obligations. We have the components of working capital management. We've been talking about this in a way, but we look at the components itself, and the components are the inventory management, we have the account receivable management, cash management, accounts payable management, and short-term financing. The inventory management is balancing stock level to avoid excess holding cost or stock out using techniques like EOQ and GIT, just in time. Also, another aspect is the account receivable management. The account receivable management deals with the accelerating collection while maintaining customers' relationship to ensure steady cash flow. So it's trying to fasten up collection process of proceeds outside in order to maintain and still trying to maintain customers' relationship, which causes a steady cash flow in the organization. We have the cash management, and this is ensuring that there is sufficient cash for obligations while minimizing idle funds through forecasting and budgeting. The account payable management deals with the strategical timing payments to optimize liquidity without harming supplier relation. And lastly, the short-term financing. This is concerned with the acquiring external funds to bridge temporary cash flow gap and ensure uninterrupted operation. A major component, a major part of understanding working capital management is also the operating cycle. And what does it mean? We can say it is also known as the cash conversion cycle, and it refers to the period between the initial outlay of cash for purchasing inventory and eventual receipt of cash from the sales of that inventory. And what are the components of operating cycle? The components are the inventories conversion period, which talks about the time to convert raw material into finished goods and sell them. We also have the receivable collection period, which talks about the average days to collect cash from customers after sales. We talk about the payables deferral period, which is the duration a company takes to pay its suppliers, providing interest-free finances. And lastly, we talk about the cash conversion cycle, which is the net time between cash outflow for inventory and cash inflow from sales. This actually indicates working capital efficiency. The importance of operating cycle, it determines working capital needs. It actually improves the liquidity. Also, it identifies inefficiency, that is, longer cycle may signal operational issues causing cash flow constraints. So it identifies inefficiency. And lastly, it supports planning. That is, it assists in managing cash reserve, the credit policy, and production schedules. The sources of working capital finances. We are financing. We have the spontaneous sources. We have the short-term bank credit. We have the commercial paper and factoring. For spontaneous sources, these are trade credit from suppliers, accrued expenses like wage and utilities, and lastly, interest-free and readily available. For short-term bank credits, we talk about bank overdrafts, cash credits, bill discounting, short-term loan, flexible. It's actually flexible, but involves interest and collateral. So as against the spontaneous sources, this one involves interest and collateral. And for commercial papers and factoring, this is unsecured promissory notes and sales of receivables, and it's quick liquidity. But suitable for large credit-worth firms. So firms that has a large and credit-worthiness are falling into this category of working capital financing source. What are the strategies that are available in working capital financing? One is the matching, which is hedging policy. We have the conservative policy, and we have the aggressive policy. Matching policy is aligning asset and liability maturity to minimize risk and ensure cash flow alignment. For the conservative policy, it is a form of using long-term funds for most assets to reduce liquidity risk, but with higher cost. And lastly, for aggressive policy, it is financing assets largely with short-term funds to ensure profitability, but increasing risk. In conclusion, effective working capital management balances liquidity and profitability by managing the assets, the operating cycle we discussed, and the financial strategy. So there is need to master these principles to ensure operational continuity, cost minimization, and sustainable growth, creating lasting value for the stakeholders. This is the end of this course, this module, and next class, which is the final one, we'll be talking about ethical issues and corporate governance in financial management. Thank you.